You've been pre-approved for a mortgage up to $500,000. You find a house you love, and after a fierce bidding war, your offer of $520,000 is accepted. You're over the moon, but then the lender's appraisal comes back. The appraiser says the house is only worth $490,000. Suddenly, your approved mortgage is in jeopardy. Your dream deal is collapsing. Why? Because the lender's willingness to loan you money is not based on the price you agreed to pay, but on the value of the collateral, the house itself. This is the most direct and dramatic way property prices affect mortgage approval, but it's not the only way. From the moment you start looking, the price of a home is actively shaping your loan options, your required down payment, and the very risk profile the lender sees. In a market where prices are skyrocketing, or in one where they're plummeting, understanding this connection isn't just academic. It's the key to navigating the process successfully and avoiding catastrophic financial mistakes. Today, we're pulling back the curtain on the precise mathematical relationship between a home's price tag and the bank's stamp of approval. We'll explain the pivotal role of the appraisal, decode the almighty loan-to-value ratio, and show how high prices silently strain your debt-to-income ratio. By the end, you'll see the housing market through a lender's eyes, and you'll know exactly how to position yourself to get approved, no matter what the market is doing. Let's start with the core principle. A mortgage is a secured loan. The security is the property. Therefore, from the lender's perspective, the single most important question is, if this borrower stops paying and we have to foreclose and sell this house, will we get our money back? The answer to that question is determined by one calculation, the loan-to-value ratio, or LTV. This is the loan amount divided by the property's value, expressed as a percentage. It is the fundamental measure of risk for the lender. A lower LTV means the borrower has more skin in the game, a larger down payment, and the lender has a bigger cushion if they have to sell at a loss. This is why putting 20% down to get an 80% LTV is such a magic number. It eliminates the need for private mortgage insurance and represents a traditionally safe risk threshold. Now, here's the critical part. The V in LTV is not the contract price you offered. It is the appraised value or the sales price, whichever is lower. The lender will always use the lower of the two numbers to protect themselves. This is the first and most brutal way property prices affect your loan. If you agree to pay more than the appraised value, you have an appraisal gap. The lender will base your loan on the appraised value, not your contract price. Let's illustrate that appraisal gap. You have a contract for $520,000 and plan to put 10% down, $52,000. You expect a loan of $468,000. The appraisal comes in at $490,000. The lender now says the value is $490,000 with your 10% down payment requirement. They will only lend you 90% of $490,000, which is $441,000. Your required loan amount is still $468,000 to meet the $520,000 price. But the lender will only give you $441,000. You now have a $27,000 shortfall. To make the deal work, you must bridge that gap with additional cash from your pocket, on top of your down payment and closing costs. If you can't, the deal falls apart and you risk losing your earnest money if you didn't have an appraisal contingency. This is why in hot markets with bidding wars, appraisal gaps are common, and waiving the appraisal contingency is a risky gamble that requires significant cash reserves. So, what determines this all-important appraised value? A licensed appraiser conducts a neutral, third-party evaluation. They look at recent sales of comparable homes, comps in the area, the condition of the property, and overall market trends. They are not influenced by your emotions or the seller's asking price. Their job is to establish an unbiased opinion of market value for the lender. This process acts as a check on runaway market prices. If every house on your street sold for around $450,000 in the last 3 months, it will be very difficult to justify a $520,000 value for a similar home, regardless of how many buyers were bidding. The appraisal ties the mortgage to tangible, documented market reality, not speculative frenzy. Let's dive into the second big impact of property prices: your debt-to-income ratio, or DTI for short. This is basically how much you owe each month compared to what you earn. Your mortgage payment covering principal, interest, taxes, and insurance is the biggest chunk of that debt. And guess what? That payment is determined by how much you borrow, which is tied to the home's price after your down payment. So, if home prices go up, your loan amount and monthly payment go up too, right? This can really stretch your DTI. Even if you got pre-approved at the top of your budget, buying at the highest price point can max out your DTI, leaving zero wiggle room. If anything changes, like a slightly lower bonus or a new small debt, that pricey home could push your DTI past what lenders allow, which is usually around 43 to 50%. So, while pre-approval is great, the final green light depends on the specific numbers for the property you choose, since those numbers drive your DTI calculation. Keep that in mind. Beyond the immediate purchase, property prices have a long-term effect on your mortgage life. For existing homeowners, rising prices increase your equity, lowering your LTV. This can allow you to cancel PMI earlier, qualify for better refinance rates, or access a home equity line of credit. Falling prices do the opposite, potentially trapping you in a home with an underwater mortgage where you owe more than it's worth, eliminating your refinance options and mobility. For new buyers, high prices force larger loan amounts, which can push you into jumbo loan territory. In a practical sense, how do you navigate this? In a hot market with rising prices, get pre-approved with a comfortable buffer below your maximum. Be prepared for appraisal gaps by having extra cash reserves. Consider an appraisal gap guarantee in your offer, stating you will cover a gap up to a certain amount. Work with a savvy agent who can provide the appraiser with solid comps to support your contract price. In a cold or declining market, the risk is different. The appraisal may come in at or below your contract price, which protects the lender but still affects your LTV. Be even more cautious about overpaying, as you could start your homeownership journey with instant negative equity if the market dips further. In conclusion, a home's price is not just a number you negotiate with a seller. It is the primary input into the lender's risk algorithm. It determines your loan-to-value ratio, influences your debt-to-income ratio, and must be validated by an impartial appraisal. Your approval is not for a dollar amount, but for a specific loan on a specific property at a specific value. Understanding this transforms you from a passive applicant into a strategic bidder. You now know that beating other offers isn't just about the top-line price. It's about proving to the lender that the price is justified by the value. Whether you're buying, selling, or refinancing, always remember, the market sets the price, but the appraisal confirms the value, and the lender bets on the difference. If this insight into the lender's mindset was valuable, make sure you're subscribed. Next, we Lines look at the proactive side of ownership, powerful strategies to pay off your mortgage faster and save a fortune in interest. Now, go analyze your market not just as a beer, but as a banker would.